Hello, everyone, and welcome to the quarterly market update for the Leonard Advisory Group. Today, we have a special guest, Brett Greenspan, on with us. Brett is a CFP. He works for Morningstar, part of our investment management team that we use. So we're honored to have him on today to help share some of the strategies, some of the market updates, and some exciting stock stories as well. So help me in welcoming Brett, and I'll turn it over to him.
Thanks, Josh. Really appreciate you having me here today. And good morning, good afternoon, everyone. Want to say thank you, first of all, to anyone who's investing with us. It's certainly a responsibility that we take very seriously. So we thank you for partnering with us and trusting us with your assets. And for those of you who aren't as familiar with Morningstar, certainly hope that this provides some value for you. And in the second half of this, we'll provide a bit more of an overview about Morningstar Investment Management and what we have to offer. So I prepared a presentation for you today. Let me get this up on my screen. And I'll put it out there. Assume that you can all hear this. If you can't, or excuse me, that you can all see this. And if you can't, just give me a holler. But I'm going to assume that you can. And got an agenda for you. I'm going to kick things off with just a kind of a capital markets overview, just a refresher of where we've been, where we are now, and where we see things going. And we'll dive a bit deeper into the U.S. economy, some of the underlying metrics there, and then again, an overview on Morningstar Investment Management and some Q&A. I did save the Q&A there at the end, but would certainly appreciate and encourage you to jump in if you do have questions as I'm moving through this. I know that can they come up as we go, and you can forget them at the end. So by all means, feel free to jump in. So kicking things off with capital markets, I think it's important to really take a step back and remember where we were last year. You think about the global economic shutdown. Think about the last time that you were leaving the office last year, what that felt like, the amount of uncertainty that you were feeling, markets with extreme volatility. And that helps inform, how far we've come. But just a reminder of what that looked like. There's just red across the screen here. The S&P 500 was down nearly 20%. There really was no safe haven except for fixed income. Government bonds outperformed in a big way in the first quarter. Corporate bonds had a decent performance here. And I just bring that up as a reminder that, there's a lot of talk about, diversification. Does it work? Should I just be, in equities given what the market's been like the last few years? This is a screaming example of diversification working, doing exactly what it should, which is, zagging when the rest of the market's zigging, or however you want to phrase it. Just a reminder that this was one of the few environments where we've seen extreme volatility over the last, really call it 5 years or so. And those fixed income positions did exactly what they were supposed to do, which is insulate you from some of that risk. Now, you surely remember also that was kind of just a blip in the radar last year. We had a terrible first quarter, but the market really rebounded by the end of the year. So if you're looking at the calendar year performance here, despite being down nearly 20% in the first quarter, the S&P 500 finished up just shy of 20% on the year. Now, there's a couple different things you could point to. Large caps certainly led the way there. We've heard the discussion about FANGM stocks, which I'll touch on a bit later. But really, the key theme was that huge outlier there, U.S. growth dramatically outperforming U.S. value. And these are historic disparities between the two. I mean, we're talking 45+% difference between those two areas of the style box. So I just point that out because that was really a key driver of performance there. A couple other themes that I want to highlight and touch on, international lagging US, that's also been a theme really over the last decade or so. You can point to a couple different things there. They had a good amount of stimulus, but certainly not in the same ballpark of the type of fiscal stimulus that we saw here in the US. There was also more issues with inoculations, getting people vaccinated or really ramping up for the vaccinations to begin in January. COVID precautions certainly were more of a hindrance internationally and in emerging markets. And on the fixed income side, again, a really strong year in an absolute sense, positive, just shy of 10% in some cases for some of the fixed income positions here. High yields were hit really hard in the first quarter as people, were getting away from risky assets, but really made up a lot of ground there as there was more of a risk-on approach as the year went on. So I suppose the big takeaways there is that U.S. growth versus U.S. value and the continued outperformance of U.S. equities relative to international equities. Now, as for where things stand at the end of the third quarter of this year, relatively flat quarter, all things considered. Small caps had been big time outperformers in the prior two quarters, but took a step back in Q3. We saw the S&P 500 about flat, and you can see their growth and value going in opposite directions. You'll see on the next slide here that those are really tracking really closely this year. Growth still slightly outperforming, but certainly a much narrower gap than what we saw last year. A couple other things to highlight, that emerging markets number, a lot of that is going to be tied to some of the volatility that we're seeing in China, the Chinese equities taking a step back due to a couple different crises they're dealing with over there. But all things considered, a pretty muted quarter from a performance perspective in the capital markets. And again, here's the year-to-date performance as of 9/30. So you can see, among the U.S. style box, pretty even performance between large cap, mid caps. Again, small caps lagging a bit now, and growth and value tracking pretty closely. So no real benefit to being significantly overweight growth or underweight value like there may have been in 2020. We see those tracking a lot more closely now. And again, just pointing out that continued theme of U.S. equity outperformance over international. There's a number of different things you can point to. I mentioned the inoculation rates and the amount of stimulus that we've seen here in the U.S. that's really driving performance, driving a lot of demand, keeping personal consumption high right now. So a couple charts just to reinforce what we're seeing here. This is a chart that shows U.S. and non-U.S. equity valuations, and it uses a formula called the CAPE ratio, and it's cyclically adjusted price to earnings ratio, and that's a lot just to say it out loud. So really, I think the best way to understand this is that this is looking at how expensive or inexpensive is that market relative to its own history. And what you'll see here is that really, going back, this chart starts in 2005, but really pre-2008, 2009, GFC, global financial crisis, you can see that those tracked really closely together. There wasn't a ton of difference. When one moved, the other two moved as well. But they really started to spread out as we got out of that crisis. Some of the stimulus we were seeing here in the U.S., sending valuations higher. And you can see that gap really expanded as we've gone through the decade. And I'll point you to this area of the chart over here. You can see we bounced off that average here between 2019 and 2020 and shot higher. So we're really at, kind of historically high numbers. We're not at the historic extreme, but we're pretty close here in terms of the U.S. equity market relative to its own history. We are seeing developed Europe and emerging markets a lot closer to their average. They're still slightly above it, but certainly a lot closer than what we're seeing here in the U.S. So something to keep an eye on, just that we're seeing valuations really expanded. It's not to say that they can't stay high. We still see corporate profits higher. There's a ton of disposable income that can be put into the markets. There's an appetite for investing that's sending some of these prices higher. But again, these are historically high numbers and something that we're certainly keeping an eye on. And then again, that value versus growth theme, I want to drive this home, and I think this chart does a really good job of illustrating just how wide the disparity has gotten between the two. So what this is showing is going back to 2004, U.S. value versus U.S. growth compared to the broad U.S. market. And you can see that really starting, pretty much as we've gotten out of the 2009 low, the March 09 low, growth has really outperformed in just about every environment. I mean, 2016 stands out there as an outlier, but really the farther we've gotten, the more growth has outperformed, and 2020 really is just a historic number there. I'll note
Brett,
that.
can you
Yep.
can you
Yep. Go
talk
ahead,
a little
Josh.
bit about the difference between a growth stock versus a value stock and some of the characteristics and a few examples for everyone in attendance?
Yeah, so growth stocks tend to be a little more risky. They're in some cases they're maybe not as profitable yet. They've had a growth in their bottom line and the growth of their business. Maybe they're expanding into new opportunities. Probably the best examples of growth stocks would be those FANGs. Talking about Amazon, Apple, which is really a bit more steady now, but still probably in that growth space. Alphabet, Netflix. And your value stocks are going to be your stocks that maybe are a bit more stable. Their balance sheets are perhaps maybe a bit healthier, but they don't have the same growth prospects. It's like supposed to use it. There's a lot of baseball on now. If you're going to use a baseball analogy, you could say the growth stocks are going to be taking your big swings. They're going to be your home run hitters, but they also come with more risk, right? You risk a strikeout, you risk interest rates going up, and all of a sudden, if you're really a debt-laden business, that's going to have an impact on your bottom line. Value stocks, some good examples would be like companies like Johnson and Johnson, which has a number of diversified businesses. Energy stocks, Exxon would be a value stock. So companies that again are maybe don't have the same growth prospects of year-over-year growth, but more singles and doubles steady performers.
Very good.
That helpful?
Yeah, I think so.
All right. Well, again, I just think it's important to take away a couple themes of what we're seeing in the market. And I think the two key takeaways would just be that US outperforming international and that growth outperformance versus value. But we have seen that somewhat reverse over the last year. And you can see on the far right here that those are really about equal year to date through 9/30.
So Brett, kind of combining some of this information, would you say that you guys still see, good opportunities for stock buys within the US? Seeing the dislocation here, but also maybe in some various sectors?
Absolutely. Yeah. You can speak broadly, you can say, oh, US equities are overvalued, but that's not to say that there aren't pockets of opportunity. With Morningstar, within our portfolios, we found a lot of opportunity in energy stocks. US financials have been quality performers, areas that we think have generally been undervalued. We've been shying away from some of those sectors that tend to be or that are a bit higher in terms of their valuations relative to their history. This is sectors like technology, communication services. But that's not to say that there aren't stocks or individual equities within those spaces that we like. It's
Sure.
if you looked at some of our select equity portfolios, you'd see a ton of Alphabet in there. That's a company that has had tremendous growth. It's trading at a high valuation, but it's also something that we really like and see potential for moving forward. So we can speak about this in generalities, but really it's up to us to find those attractive opportunities despite potentially being at a premium.
Okay.
Now, got some trivia here, and I know Josh is gonna get a questionnaire up on the screen here for you.
Yep.
So I'll give
Everyone
everyone.
should be able to see these questions in a poll now as well. So if you can answer them as Brett goes through them, we'll work on this together.
Great. So it's a two-part question here, and just wanted to put it out there. What is the best performing U.S. sector over the last 12 months? And I pulled this data through last week. There shouldn't be too much of a change in their performance here, but we'll give everyone a moment to address that one. And then after you've selected what you think is the best performing sector, also looking for you to estimate or guess what the 12-month return is.
Okay,
I almost answered it. Almost answered on my own poll, forgetting that I'm sharing my screen. So I will I will not do that.
Yes. Let's see. We got about 75%. So we'll give you guys another 20 or 30 seconds here to get your answers in. We will do a raffle like we do in all of our webinars. If you participate in the polls or do the follow-up survey, each one of those will be an entry in to win a $25 gift card. So if you need a little extra push there to participate, that might do it for you. All right, well, I'll go ahead and end it. And everyone should be able to share the results. And Brett, if you want to go through the correct answers, we can compare the results there as well.
All right, so it looks like we had a lot here in the technology space. But in fact, it was energy at 82% on a 12-month return. And this is somewhat surprising. You know, you hear a lot about the tech stocks, the comm services stocks, those FANGM companies, all within that technology space. But really, on a one-year basis, energy has been a dramatic outperformer relative to its peers among various sectors. You know, if you look back to 2020, oil prices came into the year around 60. And then really by the end of the first quarter into April, it fell into the low 20s. And that makes sense, right? You know, demand went from pretty normal to zero overnight. You know, there were instances where oil producers were having to pay people to store the oil that they had. And so for us, we viewed that as an opportunity to say, ultimately, whether it's 6 weeks, 6 months, a year, energy prices are going to rebound. And so we looked at that as an opportunity to add energy exposure into our portfolios. And that was in both our asset allocation portfolios and some of our select equity portfolios. And we've certainly seen a benefit from some of that performance. I'll note that we came into 2020 a little overweight energy as is, so we got pretty significantly overweight there, and have now trimmed that back more towards just kind of like a slight overweight. But I just think it's informative. You hear so much about individual stocks. The news is cluttered with headline grabbers about these companies doing very well, but it's really those areas that see first volatility, then underperformance that really can make up a ton of ground in over a 12-month period. So I'll pause there. Josh, any questions? I can move right into the U.S. economy.
Yeah, I don't think we had any questions that come in. Again, if anyone has any questions, just feel free to throw them in the chat. I know Harry's asked me a couple questions about the slides there, which we'll address off the webinar. But if anyone has any questions that come up, if you throw them in the chat, Brett will try to answer them live. So feel free to contribute any way along the way.
Sure. So with respect to the U.S. economy, like anything else, a lot of it centers around COVID-19 and where we stand with that. And what you're looking at here is quite an encouraging chart showing that we're really, seem to be past or just about past the third wave, which was the Delta wave. What I'll note is that the Delta wave started outside the U.S. We were hearing a lot about it before we were seeing it here, in the U.S. domestically. And internationally, it tended to peak around late August, September. And given that we are on a lag here, it certainly makes sense that we're passing the peak that happened in September, getting back towards a normalized caseload. So certainly encouraging to see a downward slope there. Ideally, that's going to lead to more normalization among the economy, getting people back to work, and removing some of those restrictions on our day-to-day lives. Now, alongside COVID, we've seen U.S. fiscal stimulus, so stimulus from the government, really at unprecedented levels. And I apologize using the word unprecedented. I make myself crazy saying it, but we're really in such unprecedented times, both from a personal perspective, from a work perspective, and really from a fiscal stimulus perspective. Last year, we saw the largest fiscal stimulus, largest peacetime stimulus ever, but largest fiscal stimulus since World War II. And that's really been driving a lot of the capital markets performance. It's been keeping people afloat who've been out of work. I want to note, though, that this was a lesson learned from 2009, where in 2009 they said, well, there was stimulus, but maybe we should have had more stimulus that would have helped us exit that crisis a bit faster. And so last year, you could say, it's almost like they threw the kitchen sink. They said, we are going full bore this time. We're not leaving any room for doubt. We are providing enough stimulus to keep us afloat and to keep the economy afloat. And, our house view is that the stimulus, did its job. It helped support incomes. It put us in a position to have a quick turnaround and to, really bear the fruit of that, as you saw from that 2020 calendar year performance. But I do want to play a bit of devil's advocate here and note that there is only so much that stimulus can do. You can get to a point where there are diminishing returns, whether it's getting people back to work, whether it's inflation, which I'll touch on in a bit. We're hearing, you can see right now the government's negotiating potentially another, depending on the day, $1 trillion to $3 trillion bill. So there's going to be another big data point here next year. And so I just want to caution that it's not as if we think all stimulus is good stimulus. I do think there's an argument that there can be too much stimulus. And if that does lead to inflation, that could potentially lead to interest rates needing to take higher. So that's something to, there has to be a limit there. And so, we're sort of navigating that, trying to insulate portfolios for both potential outcomes there. Now, that being said,
Brett, I'm going to interrupt you for 1 second here.
Please.
We had a question come in from Harry in regards to the energy sector. Do you still see that there's upside for the fourth quarter or leading into 2022? How do you feel about the valuations of the energy sector at this time?
Energy is actually still an area that we find quite attractive among other sectors out there. Part of that, despite the fact that we're seeing, 80% return year over year, that's coming off of a pretty significant low in the energy sector. So relative to tech, relative to comm services, which have been, on what's amounts, I don't want to call it a parabolic trajectory, but really a one-way trajectory higher. We still think there's a lot of opportunity there. We're still seeing, huge demand right now across industries. I noted a bit earlier that saving rates were high. We saw saving rates among consumers at, historical highs last year as people were working from home, not spending as much. And so a lot of that demand has been pulled forward into this year and will extend into next year, where people continue to spend, continue to travel, get back out there, going to restaurants, ordering things off of Amazon, which is going to require, trucks to be on the road and moving. And so, we think oil prices are likely to stay pretty high, and that's certainly going to be a benefit to energy companies, whether it's companies like Exxon, your big producers, or whether it's more those midstream companies, master limited partnerships that help with moving oil from one place to another. So broadly speaking, we're still, like I mentioned, we've still got a relative overweight position to energy, and we still think that that's something in 2022 that looks quite attractive.
Okay, yeah, Brett, it looks like Harry kind of threw a follow up there, and I'll say that we're not going to make any direct stock recommendations during the webinar today. Just not something we're allowed to do in our profession in this platform. But he did follow up that, with the threat of high inflation, labor shortages, if Delta's still not under control, how do you see this affecting the sector?
Yeah, it's a good question. That there's a ton of uncertainty out there. And so whether, inflation sends prices higher, that would ultimately, you'd think that would feed through to the bottom line of some of these companies. Now, that's not to say that they're totally insulated. Capital intensive businesses, will be more impacted from inflation than those that are less capital intensive. But broadly speaking, I think there's the idea that COVID is hopefully behind us, that we've gotten past the worst of it, and that, even if it still does persist, or we still see it lingering and there are flare-ups in the, every fall, similar to the flu, that we've somewhat realized how to navigate that, and that demand for oil is not going away, and that ultimately there are going to be pockets, within energy that you're going to find quite attractive, whether it's individual companies or the international energy versus U.S. or vice versa. Broadly speaking, energy still is quite attractive from a valuation perspective.
Okay, and I would say versus other sectors, you don't see energy being any more at risk than other sectors.
I don't think so. The uncertainty there, I can't say definitively.
Sure, right.
It's more at risk, or it's certainly less at risk. All sectors are at risk if we see, another huge spike in COVID cases. God forbid we need another lockdown. The more capital intensive, the more potential exposure you do have. But a lot of these companies are able to pass through those increases to consumers, in the form of increased, prices at gas stations, at increased cost to transport energy. And so a lot of that, they can insulate their own businesses. So from the investment perspective, as opposed to the consumer perspective, you still do feel good about the sector.
Okay.
Thank you for the questions. Those are good, and I appreciate them. Now, I just want to spend a little time on this chart here. I don't want to get into all the detail, but I will note that, in the face of all that fiscal stimulus, GDP growth has really bounced back. You probably read in the news last year, what kind of recovery are we going to have? Are we going to have a K-shaped recovery, a sideways I? Everyone trying to come up with their own acronym, and the V-shaped recovery was the hope, and that's what you've seen here with the GDP in the U.S. is really this V-shaped recovery, and we've actually revised our GDP estimates above where we had them pre-pandemic. So we're forecasting 6% GDP for end of 2021, a little over 4% in 2022, and then a touch under 3% thereafter. And again, that those estimates kind of lose steam the farther out you get as as you have to revise them, make adjustments. But long term, we do think that that the U.S. economy looks strong for continued growth, continued recovery, and again, we've revised those estimates above where they were pre-pandemic. Now, I want to spend a little bit of time on the labor market here, and this is another situation where I want to take you back to 2020. Where unemployment was at historically low numbers. We saw, if not full employment, pretty close to full employment. And then again, with the flip of a switch overnight, you saw initial jobless claims spike by a factor of 31 times. And even saying that, reading that, it's an incredible number. I can't remember which paper it was, if it was the Wall Street Journal or the New York Times. They had that unemployment claims chart on that took up the whole front page. And that really, I wish I had that in a frame, because I think that really is something that hopefully we won't see again in our lifetimes. But let me just walk you through this chart here. So the red is the initial claim. So this is people filing unemployment claims for the first time. Blue are continued claims. So these are people that have filed claims at least a week ago and are continuing to claim benefits here. And so, what we're seeing here is that we've had a pretty dramatic recovery. You're not fully back to full employment. We're not totally where we've been. I think the last number was just under 5%. But those continue to fall. We continue to see people get back to work. And again, it remains to be seen how much lower we can get that. There's still a struggle to find employment in different areas of the economy. I know we've read a lot about businesses struggling to find workers and changes to minimum wage rates. So there is a bit of uncertainty here, but very encouraging to see that despite a lot of what we're seeing in the headlines, that the last claims we saw were the best since COVID, and that the long term the employment picture does seem to be positive with some room for improvement.
Okay, I guess I'll throw in a quick question there in regards to unemployment and just people leaving the workforce. I think that is a story that's in the headlines, that increasingly more people are just leaving the workforce or quitting without a real direction of where they're going from there. So how are you guys kind of monitoring that? How do you see that as a risk in the markets?
Yeah, it's a risk, but it's also, a tight labor force is ultimately a benefit for workers, right? It should lead to wage increases. And I think you can also tie it back into the fact that, and again, I keep harping on the savings that people were able to accumulate over the last 12 months, last 18 months, that maybe there are people that feel like they have a little more freedom to take a break from their job. They've been receiving, government benefits that have given them some leeway to take a step back, decide if they want to take, look for a more full-time job than maybe some of the part-time work they've been doing. It does seem as if that stimulus is reaching an end, if it hasn't already, those benefits that that people have been receiving from the government. And so, if that is the case, if that is the key driver here, then ultimately over the next, 6, 12, 18 months, those people will return to work. They'll need to support their lifestyles. And so that's likely acting on a lag. We're still in the phase where people are, they're getting back to work, but maybe they're only going in a couple days a week. So their expenses are down from, 40%. If they're only buying lunch, a couple days a week, they're only eating out a few days a week. So we're still in a phase where saving rates are higher, but as things normalize, as people get back to the lifestyles they had pre-pandemic, I think that will lead to more participation in the workforce.
Okay.
So inflation's another topic here, and there's anyone who says they know what's happening, where inflation is going from here is taking at best an educated guess. We tend to think that inflation, like the Fed is noting, is transitory, that it's likely spiked right now. Primarily due to supply chain shortages. That's still quite, a pretty big issue is working through some of these supply chain shortages, and that's not something that they can just fix overnight. I think I saw yesterday that there's like 100 cargo ships waiting to get into the ports on the West Coast right now, and so that's going to take some time to work through that. But ultimately, long term, that will be worked through. These supply chain issues will resolve with enough time to get capacity to do so. And we think that inflation will normalize at that point. Now, one thing I'll note here, inflation's running modestly above that 2% target, but the Fed did change how they're evaluating inflation from a we want it 2% inflation to we want 2% inflation average over time. And really the idea behind that is they're willing to let inflation run higher than 2% for an extended period as long as the average over the period is going to be at 2%. So that kind of explains why they're letting it run higher right now without raising interest rates, without tapering any of their bond purchases. But long term, we expect that it should be transitory, this higher inflation we're seeing right now, and should revert closer to that 2% target as we move into the mid-2020s here. So I'll just leave you with a few takeaways here. We've seen the vaccine distribution has continued to roll out, and as I noted, the Delta variant's persisting, but we certainly seem to be on the other side of that third wave, making progress and getting back to normal here with our day-to-day lives. The economic recovery is underway. Again, 6.5% annualized through Q2, and we're forecasting 6% for 2021, and then just north of 4% for 2022. We touched on this a little bit earlier, but broadly speaking, we think the U.S. stock market, it may be overvalued. That's not to say it's dramatically overvalued, but it may be overvalued, with certain areas being potentially even more overvalued. I touched on some of those tech names, comm services, but again, I mentioned there are areas of opportunity that we see out there. Energy and financials certainly make up two sectors that we find quite attractive despite their recent positive performance. And we're just trying to avoid some of those risks of being over concentrated. There was the data point came out, I think it was last week, that those FANGM stocks, Facebook, Apple, Amazon, Netflix, Google, Microsoft, they're approaching 25% of the S&P 500, just those names making up a quarter of the index. And so these market weighted approaches, can add some concentration risk. And that's something that we're trying to avoid. We are believers in diversification, diversifying, whether it's an asset allocation portfolio or a select, an SMA comprised of individual stocks. We want to make sure that, for lack of a better analogy, that we're not putting all of our eggs in one basket. And then lastly, with respect to interest rates, the Federal Reserve is they're kind of changing their forecast with every Fed minutes that comes out, but a rate hike is expected in 2022. Whether that's going to be Q2, Q4 will likely depend on the strength of the economy, the strength of the labor market, and perhaps more front and center if inflation does seem to persist, whether that forces a rate hike. Same goes for their tapering of bond buying. They're really being quite specific by saying coming soon. So we're not a ton to go on there, but I think that's likely to precede a rate hike as a tapering and then a hike. And then we do expect that rates will continue to drift upwards in the second half of this year, so into the end of the year here. So a lot hinges on the Fed, and that's why I teed up another question for you guys here on the next slide with some history of the Federal Reserve.
And I just launched that, so everyone should be able to see those questions now as well.
So first question here, in what year was the Federal Reserve established? And then who was the longest serving Fed chairman?
Okay, and we'll give folks about 30 more seconds to answer here. Okay, I'm going to go ahead and end that. And everyone should be able to share the results. If you want to run through the correct answers, Brett.
I will, and I will just note I certainly appreciate all of you guessing that I was going to go with Alan Greenspan. I'll note no relation to Uncle Alan, though I've maybe claimed that a few times in passing. The correct answer is D, 1914, and the longest serving chairman was William McChesney Martin, who served from 1951 to 1970. Just a funny aside. My first job out of college was in Washington D.C. and I was in a building right downtown, so potentially a lot of lobbyists, consultants, whatever, what have you. And Alan Greenspan, at that point, the former Fed chairman, actually worked in the building one floor above me, and so I'd get his mail. I assume he would be getting my mail, and I tried to go up there as a fresh-faced 22-year-old to introduce myself, and he could not have been less interested in meeting. I think he had better things to do. But a couple interesting notes here. Yeah, I figured, myself, I actually had to look into when the Fed was established. I thought it might be 1931, coming out of the Depression, but it actually preceded that. So just an interesting bit of trivia history. So lastly, I just want to give a bit of an overview on Morningstar Investment Management. And I'll move through this pretty quickly. But for those of you who aren't as familiar with Morningstar, we were founded in 1984 by Joe Mansueto, based out of Chicago. And at that point in time, Joe was trying to build a business based on mutual fund research. So back in 1984, it was kind of a new space, mutual fund investing. And in order to do research, Joe had to reach out to each individual company to obtain their paper prospectus. He had to bind it, put it together and send that out for potential clients. And really over the next 15 years or so, he built a reputation for independent research. And by 2001, there was enough demanders saying, you're doing the research. Do you guys have managed portfolios? Do you manage money yourselves? And so we launched our first managed portfolios in 2001. Those were our mutual fund asset allocation portfolios. And you can see over the next 20 years, we've really grown into a global organization. So within Morningstar Investment Management, we've got offices all over the world. We've got counterparts in China, Australia, India, UK, South Africa. So when we talk about being a global organization, that's not just referring to globally diversified portfolios. We collaborate with our counterparts globally, monthly, at the least. We've got a monthly asset allocation call, but our portfolio managers, our teams are in constant communication with their counterparts overseas. We're managing, we have assets under management and advisement of just over 250 billion. And within Morningstar Investment Management, just shy of 100 investment professionals working on managing these portfolios. Now, we do have the added benefit of leveraging some of our counterparts on the research side. You see, we've got over 100 manager research analysts, 500 plus equity and credit analysts. And the work they do really makes up the building blocks of our portfolio construction process. Ultimately, the decision-making comes down to the portfolio managers running these strategies, but it's a huge benefit, a huge value add to have this in-house research available to us to collaborate with, to discuss ideas with. Now, I'll just briefly walk through, one of the core themes that runs throughout our portfolio construction process, and that's a valuation-driven approach. And really what that means is at a very high level, we're trying to buy investments, get exposure to asset classes and sectors that are trading at or below what we'd assess as their fair market value. And we do that for two key reasons. It's because historically, the data tells us that when you buy investments that are trading at a discount, you increase your opportunity to the upside. And perhaps more importantly for some investors, you decrease your exposure to a significant drawdown. Now, on the flip side, when you buy investments at a premium, trading above their fair market value, you're limiting your opportunity to the upside and you're increasing your exposure to a significant drawdown. So what we're trying to do is we're trying to buy investments that are trending towards a trough. We know we're not going to stick the low every time, but really this dotted line, if we can buy as they're entering or exiting that discounted area, that low, hold that as it appreciates to fair value, trim, ultimately sell as it exceeds it, and then repeat that process. That's really the key tenet, the key theme that runs throughout our portfolio lineup. And this next slide here is our full lineup. And perhaps, Josh, I'll hand it over to you here.
Yeah, sure. I'll run through it. I think, for us, one of the reasons that we've partnered with Morningstar to manage most of our portfolios for clients is, of course, their research that they're very famous for, and really being advocates for the individual investors. As a fiduciary, it's my responsibility to do what's in the best interest of our clients. And Morningstar gives us a broad swath of portfolios that we can use with our clients, backed up by lots of research, which we like. We're not looking to find, the hottest ETF fund of the year and try to buy that every year. Rather, for our clients that are mostly those preparing and in retirement, we want to make sure that their money lasts as long as they do. So we do that through a broad diversification of portfolios. Brett has up here the asset allocation portfolios, where here we can invest in mutual funds, ETFs. We can take a more passive approach where we're tracking indexes, or more active. They also have launched their ESG portfolios within the last group of years. And Brett and I are going to be doing a separate webinar talking about ESG investing in December, on December 14th. So keep an eye out for that invitation if that's something you're interested in learning more. We also have the outcome-based portfolios. In our practice, we use these a lot for the retirement income portfolios. So being able to specifically have a portfolio that's designed to sustain a certain withdrawal rate is really important to many of our clients, and we can see that they have a strong track record achieving their goals in those portfolios. We are also fortunate to have the select equity portfolios, where Morningstar is buying individual stocks within those accounts over some various themes, and we'll talk about those a little bit further on, but a broad diversification there. They recently also added a sustainable focused portfolio there that looks at a lot of those ESG factors as well. And lastly, we have the fixed income portfolios, where here we're able to add a sleeve in of fixed income. We can buy individual bonds or bond funds, do bond ladders. So really, with the full suite of portfolios that we have access to through Morningstar, we have really well managed portfolios that are able to meet all of our clients' needs. I will.
Thanks, Josh.
Turn it
Yeah.
back
Yeah.
over. I did see a question pop up, so I'm going to let you take this one, Brett. But ESG question mark.
ESG question mark. Yes. So ESG, environmental, social, governance investing, a pretty broad topic. It's certainly a space in investing that's growing at a pretty huge rate. There's a ton of interest in investing with your values. Whether your values are moral based, whether it's you want to restrict things that you're investing in, like say tobacco or guns or whatever your case may be, or if you're more focused on the environment, you want to invest in companies that are doing their part to promote climate change, to be responsible or sustainable investors. We've got a couple different offerings available. So that ESG asset allocation lineup is going to be made up of mutual funds and ETFs to give you a broadly diversified portfolio within that asset allocation space. And then we've got that U.S. sustainability moat focus, which really it's a slightly different than some of our select equity portfolios in that it's not actively managed. It tracks an index. And what this portfolio does, it looks for companies that, have it through two lenses. It's through an ESG lens and then also a valuation lens. We also are only looking for companies that have a wider, narrow moat there. So really, it's not just a pure ESG play. It's not just a pure individual equity play. It's really a combination of the two. And I'll just do a little promo for Josh here that I'm excited about that webinar in December. And if you do want to learn more about that, we're going to cover that specifically during that call.
Yeah, it's something that has increasingly become of more interest to our clients and investors in general. It used to be seen as more of the guy with the Grateful Dead t-shirt type investing. That is certainly not the case anymore. By no means, is it only investing in hippie companies or something like that. It's really looking through a different lens. So looking forward to that and sharing a lot of great information there. So again, keep an eye out for that invite coming through your email here in the next month or so.
Sure. So I'm going to keep moving here and just do a bit of a deeper dive on our select equity lineup. And so you saw the lineup that's available there. You heard me talk about valuation. A lot of people think that really is just specific to the asset allocation portfolios, but really that runs through our core lineup, including the select equity portfolios. We put a major focus on valuation. We think that's a key driver for returns, is getting investments at a discounted price. And then we're also focused on moats, what we would call sustainable or growing competitive advantages. We think that's one of the best ways to insulate your business from competitors, to maintain market share, to ultimately grow profits. And I will note that these are focused portfolios. So the vast majority of these are 20 to 40 individual holdings. I'll note that our international equity portfolio can go up to 70 holdings, but these are highly concentrated portfolios made up of high conviction positions that we're investing in. And I love to hear Matt Kofine, our portfolio manager of the hair strategy, say, I'm not investing, in these, 22 names. I'm investing in these businesses. He views himself as an investor in their business. So I just want to dive a little bit more into that moat topic. And so when we talk about a wide moat, we're talking about a company that has a competitive advantage over their peers that we can forecast out 20 years. When we talk about a narrow moat, that's a competitive advantage we think is likely to last 10 years, but maybe is a bit less broad than some of those that fall in that wide moat space. There maybe is room for a competitor to get in there and take market share. And when we're evaluating moat, it really comes down to these 5 moat sources. So I'll give you an example for each of these, and I'll move pretty quickly through them. I want to leave some time if we do have questions. But for switching costs, a good example of that would be Oracle. Oracle's a software company, and if you're going to switch away from Oracle, one, it's probably going to be a pretty big cost outlay. They're running the software for your business, and secondly, it's going to be a disruption to your business. It's a huge change to retrain your staff, to change all of your systems. So there's a huge benefit to them for being integrated, and that creates a moat for them to repel competitors. For intangible assets, you're talking about companies like Coca-Cola, McDonald's, where they can go a long way just based on their name. That name brand is hard to infringe on. It's, there's maybe a couple companies out there, a couple businesses out there that may be entering the, say, soda space or fast food space, but they're still quite a ways away from your Coca-Colas, your McDonald's. Network effect. The idea behind this is the more users you have, the more valuable the business is. So you could talk about a company like Alphabet, MasterCard. The more people using it, the more they can add benefits, and the more valuable the network is. Cost advantage, Amazon's probably the best example here. The amount of control they have over costs, they can just totally, run at a loss in certain spaces for an extended period to drive out a competitor, to take market share. And then lastly would be efficient scale. So these are going to be more of your companies that are maybe utility energy companies. Enbridge is a good example, where it would be very challenging to enter the space, given the cost outlay, given the resources, given the regulatory environment you'd have to overcome to be a competitor to them. That efficient scale is a huge competitive advantage for them. And you can see here the composition of wide and narrow moat among our select equity lineup. Now, one thing I'll note here is that these numbers are asset weighted. So that would mean that, for instance, for the S&P 500, you talk about those 6 FANGM stocks, they make up 25% of the index. And so naturally, I think just about all of them are wide moat. So naturally, that number is going to be a bit higher there for the S&P than it would if you were basing it on individual company names. So if you were doing this just on the individual names as opposed to weighting, this would probably even be perhaps even a bit more flattering for some of these select equity portfolios. So just one more visual here for you. This shows where these strategies invest within the style box and what their key objectives are. So the hair portfolio is looking for growth at reasonable prices. And again, it's going to be more in that top right quadrant of the style box. Our Tortoise portfolio is a large cap blend. So you'll see some growth in there. You'll see some value. It invests more in quality. So it has a mandate to invest in companies that have investment grade credit or better, or no worse rather. The dividend portfolio has a dual mandate of income and capital appreciation. All cap equity is our go anywhere approach. So this is really, if you're saying this is like looking through the windshield rather than the rear view mirror. So positioning itself to benefit from what's to come, and it can go up and down the style box all over the world. And then these last three are fairly self-explanatory. Small and mid cap equity will be in that small and mid cap space, and then international is only investing in companies domiciled outside the U.S. So I know we're a little tight on time, Josh. I can run through this briefly, or I can leave some time for questions.
Brett, I would say go ahead and run through this. I think this is a good example of some of the value that you guys can add, especially in individual stocks. So
Sure.
Go ahead through this, and then we'll answer a couple questions real quick at the end.
All right. So Discovery Inc. is a company that is held in our all cap equity portfolio. And it's a multimedia company. They've got a ton of different businesses in the multimedia space. And I highlight this because it really does show the benefits of having active management, having a long-term approach, and being opportunistic in the face of volatility. So we initiated a position in Discovery in March of last year at a price of just over $25. And saw a bit of a downturn from there, but nothing in the fundamentals of the business changed. This was just really, you could call it price discovery. And so John Owens, the portfolio manager, added to the position a couple weeks later as it was down, call it around 10% from his initial purchase price. But he still loved the business, didn't see a reason for it to be trading lower, so he added to it. And from there, you've got, really a quiet 8 or 9 months. And for a lot of individual investors, and I'll put my hand up, myself included, it can be uncomfortable to sit with a position that you're bullish on, you think others should be bullish on it too, and it's just trading sideways, right? And so, to John's credit, he maintained his conviction. And as we got into 2021, Discovery Inc. was swept up in a market event with Archegos Capital Management. And this was a hedge fund that, without getting into all the details here, was making some complicated trades that led to it being, ultimately blowing up, but really having a number of the positions they own getting, squeezed, where the price is being driven higher, way past what the fundamentals would indicate. But ultimately, companies needing to buy or sell it, and it's driving the price a lot higher. And so for John, who was bullish on the company, to see this happen is in some ways validating, but in other ways it's, well, now this is going above and beyond what I could have imagined over a number of years, a full market cycle, let alone, a couple of months. And so in March, so almost a year to the day after he initiated the position, he trimmed it at a price of 65. So well over 100% return there. And over the next 2 weeks, it kept going higher. And so on March 22nd, at a price just shy of $76, trimmed that position. And, call it fortuitous timing. Sometimes it's going to work to your advantage. If he had been a week later, he would have been selling into a pretty dramatic downturn, but he didn't. He had a steady hand, his finger on the pulse, and sold that position just shy of the high. And it reverted quite a bit lower, back towards $30, and back to an area where John said, yeah, this is about where I bought it. I still like the business. I'm going to get back into it, and reinitiated a position there. So I'll caution, I don't want to, this is, sometimes these things work to your advantage. There's certainly been instances where we've had positions that worked against us and we were wrong. But I think this is a great example of the benefits of active management, what that can do for you, and how volatility really can turn into an opportunistic event for you.
Yeah, I think just to add a little bit to that, Brett, like we always want investors to buy and hold, right? We want them to stay invested. But of course, this was sort of part of that meme stock craze that was going on, like GameStop and AMC. So that is a very abnormal event. And to have someone watching your investments at that time is of huge value, as you can see in this case, able to capture a pretty large return here in these abnormal events.
Yeah. I mean, we invest, like I mentioned, we're valuation driven, and we focus on the fundamentals. And, we like the fundamentals at 25, we liked it at 30, but at 70, price and fundamentals, we're pretty dislocated. And so that's still going to be a driver, a focus of our discipline there.
Very good. Well, we are at 11:55. So if anyone has any additional questions, I see two more that we can jump onto real quick, Brett. One more with Harry, but if anyone else has any questions, please send them in now and we'll try to address them here before we close up. But Harry had also asked, what do you see as the growth in the electric vehicle sector over the next 5 years? And I guess maybe more importantly for everyone is what's the impact on the traditional energy sector there?
Very good question. And I'm admittedly I'm someone who has been skeptical and hand up wrong about Tesla. And I don't think I'm alone that their price and their fundamentals have been a topic of conversation for many. We had Kathy Wood as one of the keynote speakers at the Morningstar Investment Conference, who spent 20 to 30 minutes talking about her position in Tesla, why she's so bullish on it, why she's got robotics analysts and AI analysts working on that. So it's not a traditional investment there. With respect to electric vehicles, it's a good question how that's going to impact oil prices. We talk about that here in the U.S. If you're like me, you're seeing more and more Teslas and electric vehicles around, but the energy market is not just the U.S. The energy market is international, and so we're not solely bullish on U.S. energy. We like global energy, and I think that the adoption of electric vehicles, in developed markets and emerging markets, is going to take a long, long time to seek the type of adoption we're just now seeing here, and so I think that should still insulate energy prices and energy midstream and energy businesses quite a bit from that. But certainly one of the headwinds that's facing that space, but long term I think that's something that is a ways away from being a dramatic impact on that.
And I think the other important thing that is maybe often easy to overlook as a consumer is U.S. oil prices in general are not just our gas consumption. Of course, they go into manufacturing, plastics, all these other pieces of the economy as well.
And we talked earlier, I talked about moat switching costs. There's a huge cost outlay that to move from oil, from traditional energy sources and having that as a part of your process to something that's a bit more sustainable, renewable. And I know we'd all we'd like to see that. We want to see us moving towards something like that. But for a business, that's a big decision to make. And until prices kind of, trend closer together, that's something that I think is going to be a bit more stubborn.
Okay. We also had a question come in. What should those who have purchased ultra short bonds expect to see when the Fed begins tapering bond buying, increased or decreased performance?
Well, I think ultra short bonds should be the ones that tend to be a little more insulated from rising rates. They've got less duration. Rising rates are going to tend to impact more long-term bonds than short-term. So I expect if you're in ultra short-term bonds, it's really because you're more or less want to be in cash, but you don't want the returns that cash can offer you, and so you're in kind of the next best and next safest position. So I think those in that space should probably not be as concerned by that as what you might see for those in more long-term bond portfolios.
Okay, I guess sort of on that same thread, as we see the Fed raising rates, assuming that they do next year in 2022, do you see that impacting the market much, or is everyone watching that so closely that it may be more priced into the market when they finally make that move?
Very good question, and like almost an age-old question. Like, is that priced in already? Have we seen the impact of that yet? If the Fed does raise rates, and if it does steadily raise rates, impact is likely to be more on those companies that have more debt on their balance sheets. Some of those more growthier companies who maybe are trading at higher multiples right now, that if we have to discount that cash flow at a higher number, that's going to be more impactful for those kind of businesses. So if rates do go up, and people have been saying rates are going to go up for a few years now, so I hesitate to say that's a certainty, but if rates do go up, it's likely to be more of an impact on those companies that are more in that growth space.
Yeah. And I think for some of our clients, it might be a benefit to have a little bit of a rate increase, because as we saw prior to COVID, some high yield savings rates were hovering around 2%, where now they're down to 0.5% or less. So,
If you're lucky, right?
yes,
Yeah,
certainly for those that want to have more cash, it's a tough position to be in these days.
I'll just add it. I was on a call with George Metro, who runs our dividend portfolio, and that's a portfolio that you might think is relatively sensitive to a rate increase. And what he noted is that, we're still in like a rate increase is good environment. If they're going to raise rates, it's because they're confident in the labor market, they're confident in the state of the economy. They maybe feel that it's an appropriate time to kind of put a stop to maybe some increased inflation. So we're still in an environment right now where if the Fed ultimately does decide, yes, it's time to raise rates, it's likely coming on the heels of some quality economic output.
Okay, very good. Good positive way. Thank you so much, Brett, for your time today and sharing all this information with us. For all of you in attendance, thanks for joining. I hope you found it informative, gave you some good information. Again, we love working with Morningstar because they keep a steady hand. They're looking at mass amounts of information and trying to make informed and well-diversified decisions in our clients' portfolios. And especially in these uncertain times, that is a huge asset to have. So thanks again, Brett, and thank you everyone for attending.
Thanks for having me. Have a good day, everyone.